Morning, everyone. Hope you're doing fine and dandy. The day after the night before, we've had the Fed, lots of moves, lots of no one knowing what's going on by the looks of things. Morning, Kate. How are you, mate?
Morning, Ryan. Morning, everybody. Yeah, I'm good. Ready to rock and roll again today.
Yep. We're not done with the central banks.
Oh
Bank
no.
of England to come, and well, is it SARB today as well?
Oh yeah, the funniest central banker of all is on today as well.
Yeah, might have to tune into him for a bit popcorn watching. Right, lots to get through, obviously. So let's get stuck into it. Over in China, their VP, Vice Premier, says that they're willing to work with the UK to restart an economic and financial dialogue, promote trade and investment, liberalisation and facilitation, and expand cooperation in finance, the green economy, biomedicine, and AI. That's according to state media. Whether that gets any traction, we've yet to see. Still, a lot of Western countries not happy with what China's been up to, namely in bed with Russia and Ukraine and all that sort of stuff. So it's nice to talk, but we'll see if it comes to anything. Over in Japan, the head of the Bankers Association says that the industry is seeing more inquiries from individual customers concerning the impact of interest rates and fixed rate products, such as for housing loans. That's a bit of caution for the Bank of Japan to take into consideration while they think about hiking rates further. It really is, it does bring home the situation in Japan where getting rates up 10, 15 BPs a clip to a lofty level as they are now, how much pressure it can put on a population that's used to rates being sub-zero for so long and low enough for so long. So that's one of the things that falls into, as I say, the category of worries for the BOJ. How much sway will they put in things like that, Kay?
Oh, I don't know, Ryan. It's never. It's Japan. That's always what we can't forget. It's not really. The Bank of Japan independence is up to a certain point, and but they will always take into account what politicians or even like the unions and stuff are going to say. So yeah, I don't know. I for if we look forward to this meeting, for instance, I don't think it's going to change too much because they're not expected to do much, but it could just impact their longer term way of thinking, right?
Yeah, exactly. Personally, for the meeting tomorrow, I'm still expecting maybe a bit more of a hawkish tilt,
Yeah,
or at least continuing comments to. Yeah, they need to keep the momentum going. They don't want to, give up what they've gained so far. We're talking
no.
about rate hikes, so I think we're probably just going to get a bit of a push on that side of things.
Yeah,
Maybe a clearer suggestion of when they're going to hike next.
yeah, in words, I agree, but in actions, I don't think they do anything right now. And it's not only to monitor what's happened or that big yen appreciation. Also, I think it's perhaps more to do with these LDP elections coming up. They don't want to be seen as throwing politics upside down either. So as I said, it is Japan, right? So I don't think they will change anything to the rhetoric that they will hike rates because they can keep it there as well because we see the JGB yields. Well, at least not going higher. They are not coming off with all the rest of the yields, but at least they are not going higher. So there's still no how shall I say? There's still no way of going like, okay, we have come far enough. Not in the way that we've seen, for instance, US bond markets, European bond markets, other bond markets front running and front loading what the central banks will do and maybe doing. In Japan, it's more stable because they are on a hiking path, so it didn't really come down, but they can keep just the half hawkish rhetoric going without doing much tomorrow.
Yeah, exactly. Right, coming over to those guys down under over in Australia, we had some employment data out, which was modestly good. The employment change was up 47.5 thousand, so well eclipsing what was expected, 26.4. However, the bulk of that, well, the majority of that was coming in part-time employment, because as you can see, full-time employment actually went down. So part-time jobs, which isn't necessarily a strong signal. Jobs is jobs, that's always good, but you want them more in full-time than part-time. Participation rate stayed unchanged, as did the unemployment rate. So the fact it didn't get worse is probably a bonus there. So overall, a moderately good set of jobs data there from Australia, which has helped the Aussie dollar in part this morning, amid what's going on with the US dollar generally. Norges, they kept their rate unchanged as expected at 4.5%, saying that they're going to keep their rate there, all being well, until the end of the year, when then in Q1 2025 they will look to start a gradual rate cutting cycle, easing cycle. Governor, well, they also reduced their inflation forecast for 2024-2025, unchanged 2026, and the same for GDP, came down a few pips, 24-25, unchanged for 26. Governor Bache said that rapid inflation decline is not expected to continue. And they said their rate path implies slightly faster rate decline through 2025. So once they start cutting rates, it could be a bit of a faster process than they previously thought. Kay, any thoughts from you on the rate stuff from Norges?
Yes, I said if you don't want your Norwegian kroner to weaken, stop selling it. Well, although the amounts are small. Yeah, and there was a bit of a line that if Norwegian kroner would continue to weaken, they could actually go the other way around. But I think it's really not in the actual plans to hike again. But yeah. What can I say about this? It was mostly all as expected to keep the rates still until the end of the year. They are struggling a little bit with the overall. We know that the Norwegian kroner versus dollar, for instance, has strengthened, but everything has strengthened versus dollar mainly. Yeah, they're still a bit worried about the weakness of the kroner, so that's one reason why they're keeping it. They're keeping yields unchanged right now, so they reduce or even do better on the differentials versus other countries. I don't think it changes much. It's really, as we can see as well, Norwegian kroner has been plugged onto the moves that we saw in oil and gas, right? So at the lowest of the Brent prices, Norwegian kroner hit its lowest as well on this round, and now with Brent coming back up and the dollar being a bit lower, it's coming down in sympathy. Let's also not forget that Scandinavian currencies are a bit are linked to what risk is doing as well. So besides what the central bank may do, Norwegian kroner will be driven by risk as well. So risk is doing better. Norwegian kroner is also doing better. Also, we can see the same thing in Swedish krona, for instance, as well. So I don't think the Norges Bank changes a lot to the global picture of what's happening in Norwegian kroner now. The market has probably bigger fish to fry.
Yeah, that'd be my thoughts. Some big fish it is as well. Over at the ECB's Nagel over in Germany, and some strong comments, says inflation is currently not where we want it to be. The ECB must demonstrate it has the staying power to defeat inflation. It says upcoming wage deals in Germany likely show rapid increases, hence why he's being so cautionary and warning about inflation, because they're set to have a big uptick of wage inflation over there. Then added that intervals between potential rate cuts may vary, will not commit to any future rate decision. The Germans are in a bit of a pickle, mate. They've got potentially high inflation coming in, and an economy that seems to be tanking. So they want higher rates on one hand and lower rates on the other.
Have you got good news from Germany? I don't know. They need the Rhine water levels to get back up, mate, to get back out of their slump. There is that's just been the all-time high. As Gavin says, that's probably different right now. But yeah, I mean the supposed engine of Europe is not even sputtering. It's just come to a virtual standstill, right?
Been towed behind at the moment. The likes
Yeah,
of
exactly.
likes of Spain and Italy and Greece and everyone else, all the other pigs
Yeah,
are pulling it along.
yeah. And you know what? There's also a bit of politics going on because they are one of the countries in Europe that don't want to like cut the bridges with China. So there's a bit of China perhaps in there as well. China needs to revive for Germany to revive to buy cars and whatever not. Yeah, I don't know. I don't know about Germany. We've historically seen that Germany has the capacity to get out of slums and in a big way. But today I'm really failing to see what in the immediate is going to pull them out of the situation they are in right now.
Yeah, every day it seems more and more that
Yeah,
they put too many eggs into the China basket, really.
yeah,
And
we don't have too much good news either. I mean, ruling parties can't virtually do anything because the elector veers to the right, and they're getting more and more blocked. And I don't know. It looks like a bit of an atrocious situation right now.
yeah, exactly. One we need to keep an eye on. Right, over in the US, we'll get stuck into the Fed in a moment, but yesterday, a little bit of data out. We got the NBA data coming out, which aside from showing a solid pickup in applications, mortgage applications, the 30-year rate came down 14 pips. So that is playing into what we've seen. We probably expect another drop in that now that the Fed's gone 50, but these mortgage rates were coming down already in anticipation of a Fed cut coming. Activity has picked up quite significantly in refinancing, purchase index, the index as a whole, which again plays into what we were talking about, financial conditions. You know, these rates have been coming down for quite some time, even before the Fed cut yesterday. So that's the market already planning ahead for rate cuts. So those financial conditions have been loosened, and they're going to be loosened even more with that 50 pip rate cut as well. More soft landing data from starts and permits. A couple of months ago, we were on a 3-month losing streak. Now, I believe we're on a 2-month positive streak. Permits coming in above expectations, 1.475 million. Housing starts, 1.356 million. So a decent bounce in those. And again, low rates or expectations of low rates could be helping that as well. Financing for building projects obviously getting cheaper, and obviously mortgages getting cheaper as well. So maybe the US will stave off potential mortgage blip from all those high rates, and it will get the housing market moving. This is one area, Powell, and as I said, we'll talk about it more, but one of Powell's things was behind the 50s reasons was that it will help the economy in its soft landing, and it could bring about increased activity. If you're going to see the effect of rate hikes, which usually take a few months to come through, you'll see it early in things like housing. As I said, housing, finance, mortgages, they're going to be affected much quicker for rate cuts than anything else. So that's going to be an area to keep an eye on moving forward to see how these rate cuts are doing. Bank of Canada had their minutes out, and a bit of fence walking from those guys over there. They still see some risks from higher wages stoking services inflation. But during the meeting, they discussed a scenario where the economy could rebound faster than expected. And in that case, it might be appropriate to slow the pace of cuts. But they also discussed a scenario where the economy and labour market could weaken, and then it might be appropriate to speed up the pace of cuts. One thing Powell's done now is let the 50 BP cat out of the bag. He's opened that can of worms now. So we're already pricing a 50% chance of the next BOC rate cut being a 50. We're going to be doing that probably for many other central banks as well. Right, so over to it all. The Fed cut rates by 50. They see rates at 4.4% at the end of this year, 3.4% at the end of next year. So that was a bit of a drop down in the old dots. There was one dissenter who was Bowman, who wanted a 25 pip cut, one of the big hawks there. I'm a bit surprised personally that she was the only one, but it just shows you what the thinking's like over there. There was in the statement, and this is a bit of a weird one, because I read the statement and there was no significant pointing towards why a 50 over 25. There was slightly stronger rhetoric on protecting the jobs market, i.e. making sure that it doesn't weaken too much. Obviously still watching inflation, though Powell took a bit of a victory lap on the progress so far during the presser. But the statement itself was pretty meh. Yes, they're watching jobs. Yes, they're still fighting inflation. Yes, they're still supporting the economy. But there was no reason in there why a 50 over 25. And it took some 20 minutes into the presser before we got an answer to that question, with Powell saying that they aren't behind the curve, but the reason for the larger hike is that they didn't want to end up behind the curve. A lot of analysts and banks and whatever this morning calling that very fact into question, because he made plenty of references why the economy was doing well, which almost seemed to talk up why a 25 would have been just as an appropriate response. It did say if the economy remains solid, we can dial back the pace of cuts. Equally, if the labour market deteriorates, we can respond. He said the direction of our process is towards a sense of neutral. So they're still trying to find where their neutral level is going to be. He said no one should look at 50 BP cut and think this is the new pace. Well, he's certainly blown that out the window already. So overall, we made a bit of a mess last night in the presser. He was a bit all over the place, this one, not the composed Powell that he was usually, Kay. Is that a sign that they were worried about how the 50 would go down?
No, I think it depicts, because if I read it correctly, the initial votes were like just a small majority to go for 50, and then of course they build a consensus around it. That's how I think it works, if I'm not mistaken. And then people can stay dissented like Bowen did. I think it reflects the fact that there was only a very small majority going for the 50 BPs cut initially. And I think the 50 somewhere reflects what Powell started to say, like, now a couple of months ago, if I'm not mistaken, even before Jackson Hole, that he didn't really like what he saw on the unemployment rate, to just name that one. Yeah, explaining it was a bit tough, I think, also because of there was not a clear, like it was not unanimous, the 50, and especially not initially, if I read that correctly. And that's perhaps why I think the 50 is you know, we were ourselves somewhere 51-49, 25 or 50, and it looks as if the Fed initial vote also reflected exactly that. that it was a very close call between the 25 and the 50. I think the 50 is really reflecting what he said. We want to support the jobs market. We want to support the economy. Yeah, and that's really what I'm taking away from it is showing the support, and that's basically the reason for the 50. And also the fact that they are like, if you take the mid rate where the Fed funds were like 537 and a quarter, it was a very high rate, right? So there was a lot of room to start with there. And also the market already front ran and front loaded potential cuts to come in a heavy way. And traditionally, historically, they are not like telling the markets, they say if the market price is in like humongous cuts, they are not going to say like, no, we don't cut or we hike, you know. They usually tend to go somewhere in the way of the markets. But he can't really say that openly during a press conference, right?
Yeah.
He can't say, he can't go out there and say like, oh yeah, the markets are right. I mean, that is not how they function. But yeah, that's what I take from it. Of course everybody can comment he wasn't feeling at ease, whatever. But if you look at it at the end of the press conference, and then you look at the whole press conference again, yes, they cut 50. They look to 25s on the meetings to come, continuing because they revised their projections for inflation lower. They widened just that slight bit the band and increased it slightly. And that was a good point by Magix in our room, by the way. If they increase the range, the expected range of the unemployment rate, it also gives them the liberty of only doing 25 if it only ticks up by 0.1%, for instance, and not going to hit straight away the top end of their expected range. So he keeps everything open. And now we really go back to data dependent on the next jobs report. So yeah, I think there was logic in what they did. But then again, over the presser, he did the same exercise again, walking all sides of the aisle and going up and down the rows a couple of times, especially towards the end. There he went completely left and right, left and right in 2 minutes time at the end of the presser. So I think it all reflects the uncertainty there was about the size of the cut, but it does give them some freedom in the next actions, but putting in place a kind of scenario where it is like we are going to cut 25s for quite a while, and that's what I'm taking away from the market really, and that is
Yeah.
supporting more risk.
Yeah. Well, that's the next question. What are we seeing here? Are we seeing risk on because a Fed cutting 50 is being seen as that's going to support the economy? It doesn't feel that way, because otherwise you might think that the dollar should be strengthening on the back of that, and yields should be strengthening on the back of that. Or is this the market seeing an uber dovish Fed and going that way instead?
I think the read is
been up
here
and
we
down
will
and all
support
around
the.
over this.
Yeah, I think the read here is we will support the economy, and that is since the bond market already front ran a lot of cuts, and even the market for in 2025 like was really even front loading a lot more than what may be expected. But since he kind of gave them the 50, the bond market didn't find it necessary, because we haven't moved an awful lot, right? On yeah, you had those algo bleeps and whatever you can think of. But if you look at where the tens were before the announcement and after the announcement, you're not in a majorly panicky market where they have to rethink their whole book, like we have seen a couple of times, like post-pandemic, where the bond market goes like, "Wow, this is not the right decision. Let's go all the other way around." It doesn't seem the bond market has to do that. And if you have a stable bond market, that could actually also be good for risk. And then this is kind of what we are seeing now reflected in the market right now. But the thing is, Ryan, it's all fragile. We are, what is it, 2 weeks away from the next jobs report. If that's a crappy one, then this whole card house positive risk could completely fall apart as well. But in the meantime, I think the risk market takes it as pretty good because the bond market is stable. We are they are saying we are going to continue to cut. That's reflected in the dots. They put their inflation expectations again a tenth or so lower. That's all positive as well. So that is what we are trading right now. Once the dust settles, yesterday was a bit of a, I mean, nobody knew where to go. But first of all, they sold massively dollars, then they bought it, then they went completely the other way around again, buying dollars, and then in Asia they did like a pretty wonky session as well, both sides of the alley. But we are seeing now that you see, and I'm looking at not only the dollar, but you look at some of the risk pairs, they are doing pretty well as well.
Yeah, very much. So I think this, it's still difficult to say, okay, Fed's done, this is a direction. Like you say, I think there's still a little bit of shaking out to do, perhaps, and market really going to pick a side and decide what it wants to do. And as we've been saying, one bad data point and we're back playing the dovish game again, and the 50s are expectations are rising, and all that sort of stuff is happening. So that theme hasn't gone away, and as we've been saying all week, the rate cut cycle is starting. They will be getting rates down. They want to get rates down to a neutral level. Okay, that's the whole aim. As well as protecting the economy, inflation, all that. They can't have rates up this high for too long, so they want to get them down. That's not going to change. All we're going to be doing is seeing how the market wants to interpret the data points yet again.
Yeah, and speaking about the neutral rate, Ryan, and we get a lot of questions about where is it. Who knows? I mean, and that brings also the Derridge's question in there. Has the election played a role in this decision? I don't think so. But of course, it's never far away from the thoughts because it's a month away. But I don't think the election has played a role. But the thing is about the neutral rate, we don't know, because if you talk about the election then, and imagine that we get Trump, we could be looking at inflation ramping higher again, and that they are not going to like that at all. So it has not played a role, and where the neutral rate will be is anyone's guess right now. And the neutral rate could actually depend in parts on what happens during the elections. That is a potential. That's a possibility. Ask me now. I think the neutral rate is somewhere a healthy dose above where inflation is, because I think in this round, at least in this round of the cycle, they will want to end up somewhere with some kind of positive real rates, because that's always a little bit better globally if you have positive real rates for the saver, for the economy. But in the meantime, you bring the rates lower so you don't hamper economic like investments and things like that. So for now, the neutral rate is a wild guess. Imagine that we stall at 2% inflation. I guess the neutral rate is going to be somewhere 2.75%, 3%. That's a rough guesstimate. But hey, get an election that turns out a bit strange, and Trump comes in and puts like all those plans in place. Your inflation could be at 3.5% or 4% again before you know it.
Yeah, no, exactly that. And also talking about real rates, they want to keep wages real as well above inflation. So that's again another reason why they go for maybe a bigger cut now, because they know hiring's slowing. If that picks up again, then you start getting the skill shortage kicking in again, and hot wages start creeping up again. It's all a fine balance for these guys, and that's why they get paid the big bucks to try and do it. But the election, is the next thing that we go on to outside of the data. And obviously then what happens to inflation? Does it stop at their target or does it keep going? And then that's another conundrum for them. Who'd be a central banker, eh? Right, speaking of politics, as expected, the vote yesterday on the funding package by House Speaker Johnson got short shrift and was booted out. This is, as we've been saying, the usual early vote horseplay stuff, where they try and tack on other bills and bits and bobs to the funding bill to try and get that passed. So it's fallen at the first hurdle. We're probably going to see a bit more to and fro on that. We have less than 2 weeks now until D-Day for the funding deadline. It's still likely, very likely, that they kick the can. Neither side will be wanting to take the blame for shutting down the government a month before the election. But we're probably going to do the same old stuff where they argue and kick and scream until the 11th hour, and then they'll boot it probably into the new year. So the hot potato becomes lands in the lap of whoever's taking the seat in January. But we're still going to get some, as I say, political horseplay until then. And speaking of the rate cut, well, we knew it was coming when, if and when they did it, and now the accusations and the claimings is started. Trump's not happy with the cut, says that the 50 pip move is the Fed admitting that the economy isn't doing so well. Biden is up today, Biden's up today, apparently going to claim the win for the rate coming down, inflation coming down, and the fact that jobs and Powell painted a picture of the economy not doing too bad. I know you found that funny yesterday. Biden put out a tweet, said he was going to celebrate the economy and talk about it today, and then put a load of comments out straight after that tweet.
Yeah, I mean, are we Thursday yet? I mean, that was so funny. I had a big laugh on my desk when I saw the line coming, the 2 lines coming. Like, I will comment on it on Thursday, but let's do it now.
Yeah.
Yeah, that was very funny. Yeah, I was just reading the comments in the chat. We can come to it a bit later, perhaps.
Yeah, no worries. Right, so B of E day.
Let's talk about the best central banker coming up, Ryan. Well, I mean, at least if you look, if you start from down the ladder.
Well, these lot often wouldn't even be able to reach the ladder. But anyway, the good thing about today is there's no press conference, so it's just a release and statement and minutes and whatnot. The next one is November, when we get the next forecast meeting that comes with a presser. So fortunately, it's just an announcement today. Still low expectations for any change in rates, though I think the expectations have ticked up slightly after the 50 from the Fed. But just whether it changes Bailey's or their statement or whatever, the 50, I don't know. They may sound a touch more dovish. As always, we're going to need to look at the votes. Let's get those up so everyone knows what we're talking about. So we are expecting a 7-2 unchanged. There's some looking for an 8-1. So there or thereabouts. We know it will definitely be a 1 because Dingler will likely continue to vote for a cut. So 8-1, 7-2 is the large expectations, okay, to keep rates unchanged. Anything higher in the cut column will indicate that maybe a cut is closer than expected. It will be it's a way that they can signal perhaps a cut's coming maybe at the next meeting. If we see something like a 5-4 in favour of unchanged, then we could probably assume that the next meeting we're going to get a cut. 6-3 will look a little bit dovish as well, but 8-1, 7-2 is what's expected, so little reaction likely from that. And then in the statement minutes and whatever, we'll get to hear how they feel things have progressed since last inflation numbers, last data, so on and so forth. So not expecting anything massive. The market, as I say, might be leaning a little bit more dovishly after the Fed. So there's a risk if they're undovish, that we see the pound gain. I think cable is maybe the best opportunity if they are pretty dovish, because as you can see, dollar's looking pretty weak against a lot of these pairs. So if you get a dip in cable, that's probably going to be at risk of a snapback. And I'm going to be looking at that one very carefully. Euro sterling, I've still got my BDI on, but it's a bit of a make or break what happens down here. If we get through this BOE, and even if they're dovish and we don't break this level, then I think I'm going to start knocking into some longs. But I'm going to be keeping a close eye on cable for that volatility difference. Kay, your view?
Yeah, I agree on the cable fully. There's a bit of uncertainty around the new person, right? Taylor. Could he be like the third for to have a 6-3? Or is he already included in the 2 of the 7-2? I don't know. I think 6-3 may be, yeah, Taylor in there, the new one. I also would like to draw the attention to the quantitative tightening, because it could be just the kicker if not a lot else is happening there, because if they want to keep it at 100 billion, we've got 87 billion about to mature in the next 12 months already. So they could bring it down. I think it's now 44, 45 or so. The actual QT, they're selling bonds, but they could bring it down to like 13 billion to stick to their 100 plan. If they go above the 13 billion door, well, I mean, 13 give and take, 15, let's call it 15. If they stick above, that means that their quantitative tightening is actually going up in next year. So that could be a little bit of a kicker if the rest of the report is extremely neutral. And lastly, I just don't want to completely rule out the possibility. I know that it's like 90% done that they don't change, but as I've been saying this week, we have 2 months of flat growth. Could they take it as an excuse now that the Fed has gone 50? I probably would say no, but I wouldn't completely rule it out. Those 10-15% that they go with a sympathy cut, and that would, in my opinion, turn sterling around, but maybe not completely versus the dollar, but because I fully agree on the cable, by the way. But the euro sterling is one where I say if they are undovish today, I think that lower end may be toast. And the main reason would simply be that at equal data, you're looking at a 1.5% or 1%, 1.25%, 1.5% differential with the ECB. And as we have seen, UK data, even in the past months, have not been worse. On the opposite, a little better than in general in the EU. Okay, so I think today it could be a bit of a make or break scenario for the euro sterling.
Yeah, no, I agree with that. And Ali, no, I'm not in euro sterling yet. I still like the level, but I know what could happen here. We could see if they are a bit dovish, we could see this rally. But then if cable's dipping and it screams back, then euro sterling will go back down again. So I think I'm probably going to wait and see where we are at the close today, and maybe even where we are at the close on Friday. But if we're still down here come Friday, we haven't broken it or we're back above it, then I will consider maybe trying a long, but I'll be thinking more so about sell stops in that situation to get short if it does break, much like we've been talking about the last couple of weeks. If levels are going to break, I want them breaking on their own, under their own steam, not just because there's been an event. I mean, if we look at the S&P, that was an exact candidate for that type of move, and we got exactly that. We had this break up through the highs, ran up 20 odd pips up to 57, and then wallop, we just turned right around. Those are not the moves you want to look for in a break. This is the real move, as you can see. Then we've grinded back up to the highs, we've messed around the highs, now we've built upon the highs, and off we go. So this is the real move. These are the fake moves that you've got to be careful about when trading against the highs. I'm feeling a bit of a passenger in this one because I was looking for a dip back to that 70 levels after that one, and never got there. And I was half a thought of chasing it, getting in about 81, but I don't like buying tops. So I left it, and it's left the station now and on its merry way. So we're going to have to play the same game again up here. Where is the resistance going to come in? Going to have to wait and see, let the price develop. We know where the main support is right now. It's down at the break point. So keep an eye on that one. Maybe we'll get some support coming in now here at the figure just below the figure 90s. So like we did all through this rally, you've got to let the picture develop. You've got to let the levels build up before you start thinking about where the tops are and whatever. Playing this game all over again. All these little levels that turn into bigger levels, that turn into solid levels, then they turn into levels you want to trade. So short-term stuff at the moment. I know people are probably throwing the extensions, fib extension, all that sort of stuff on it. But for me, I'll let it develop itself. Right, cool. Been waffling. It's nearly 15:15 already. Kay, do you want to have a look at a few bits?
Well, yeah, I can do. I mean, yeah, let's look at those metals here because I know a lot of people are looking at the metals, especially now gold is pushing again against those highs. So to me, there's two ways of now looking at this. All right. And I know the longer term looks even more positive than this. But okay, yesterday we'll look above the kind of equal legs here. This is the range that we had before, 2730, 2430, 2470, 2530, sorry, and then you knit it on top, coming out somewhere. I think I'm a little low there, but somewhere around 90, 93, 94, whatever. We're a little look above because of the algo moves and things. But there is a possibility here, and it will depend obviously on where the dollar goes in general. And I'm still relatively, well, not relatively, I'm still pretty bullish on this one in the long run. But there is a possibility. I don't think it's going to take as long as this one, but there is a possibility that we change the range somewhat, okay? And it happens, you know, when you look back, you go onto a new level, you form a range. You go onto a new level, you form a range. You go onto a new level, you form a range. And I'm not excluding this possibility here, unless we break 2600. If we break 2600, then I think one step at a time we could see 26 26 and a half, okay? But just keep it in mind, right? So the first real level that I had here at 25.65, I told you that was too close for comfort. Let's look at what happens at 25 and a half. Bit of an algo move below, and we bounced. What was interesting as well here is that during the Asian session, where the dollar got bought, you know, you saw the dollar yen moving up to close to 144, euro dollar crapping the bed down to 110.70. It held 25 and a half. Okay, so now this is telling us that this is a good enough level to start to monitor. Okay, but what I'm doing for as long as we don't really break here is and people in our room will have seen what I've done. As I said, I've let some go because of the risk of the FOMC, and I will be buying back. That's what I did. 25.60, 25.50. I bought some. Now today, I've done again exactly the same thing because I don't know whether we are going to break yet or not. Letting some go against it, but I think if it breaks 26, it's probably going to, I don't know whether the market is going to respect this 26.15. I think there is a potential, especially also looking at equity markets, looking at the global state of the dollar and things like Aussie and things are pushing through as well. This is potentially made for 26.50s, but always respect the ranges, okay? Silver did about the same. I told you, right? Watch this 30 figure a quarter. We went below, stop run, and then we started to bounce again. And now we are again against this zone here. Yes, we could argue that we broke the prior high and we are holding. Yep, okay, no problem. And I think this is the scenario also, because where Powell was, this was what I was looking for as well in the statement. Is he going to be supportive for the economy? Yes, they seem to be supportive for the economy. So I do think that this silver has the potential over time to get to 32.5. I'd love to see Dow break above 31.45 to do that next buck, and why not higher? But then we'll look at stuff afterwards. The one that we need to keep an eye on here as well today. Hey, Aussie. Aussie is pushing. And I know some people have this trend line already in the 68.30s here, but I have it a little bit higher, around 68.60. But we are now in the process of breaking 68 and a quarter, it looks. And we're trading just above 30. Still a bit fragile, obviously. We have seen that many times. You have a little bit of a break and then come down. But let's wait for also confirmation to really say that we are pushing, and it is possible for as long as risk. Aussie is a risk currency, right? And Aussie is a commodity currency. Commodities are pushing higher, risk is pushing higher. We had an unemployment report which on the surface was good, but the creation were merely part-time jobs. So I'm not looking at that as an overly groundbreaking or record-breaking jobs report. I don't think it is, and because I don't like the balance between a flat full-time job and all the job creations being in part-time. But the market takes it and takes it positively, I think, for a couple of other reasons too. But wait, if you're in the Aussie, keep a very close eye on this one here. But if this goes through 68.70, then I think we could be off to the races. Okay. I'm just looking at the time. I'm not going to go through all the yen pairs, but as I was saying, we don't expect the Bank of Japan to move this time. And look at what happened in most of the yen pairs. First of all, risk. Secondly, the market got their 50, but the market already front ran this move. Okay, so the bond market stalled. The bond market is not accelerating to the top side. Yield markets is not accelerating to the downside. So that means that there are still yield differences in there, and it's positive. And we are in a positive risk market right now. So look at those yen pairs. It does seem to me that the yen could end up being a loser of this central bank fest, especially if sterling, if Bank of England is not dovish today, if they are not overly dovish today, we are trying to break. It's a bit too steep for my liking, but we are breaking above 188.30. Look at this level for when they will come out, the Bank of England. But also look at this one, the 38.2 around 190.80. If this goes through, that's probably going to help all those yen pairs to be bid. So if you're a dollar yen trader today, don't look at dollar yen only for guidance, okay? Because all the rest of the yen of the dollar pairs are a bit under the cosh, as we can see. But if the dollar yen is bid, and that is due to all those crosses and due to the risk environment, okay? So watch out. If you want to be short dollars, I'm just saying, perhaps the dollar yen is not your best instrument today. And with that, Ryan, back over to you.
Yeah, thank you very much, mate. Definitely a day where not all dollars are the same, and that's evident. So, yeah, we'll try and navigate our way through all that today. Take care over the BOV. Trade safe, as always. We've got a little bit of data from the US later on. Keep an eye on that. This will be the perfect time for initial jobless claims to put a wonky one after the FOMC. So keep an eye on that as well. What?
A 200K print today.
Yeah, you know it. All right, have a good one, everybody, and we'll catch you up tomorrow. Cheers all.